Hi, Gary. How are you?
I'm good, thanks, Andrew. Good evening.
And a very good evening to you too. How's everyone else there, Brian? Can you all hear me okay?
Yes. Thanks, Andrew.
Perfect. All right. Let me just pop that over there. So tonight we'll just be going through what's been happening in the last quarter, so to the end of June. There's been a fair bit going on, as we all know, so I want to have a look at not just what's happened in the various property markets around the country, but also what's happened in relation to financing, particularly with what's, I guess in store for Australian expats. We're going to do it in a slightly different format today because I found some of the last, few sort of general reviews have been pretty long. So what I want to do is go through some of the key areas first, and then we'll have a bit of a break and do some Q&A where you can ask questions. I know quite a few people had questions in relation to some of the mooted changes that may come into force if the recommendations from the Board of Taxation that were released in this year's budget get adopted. So I know there's a fair few questions about that, and then come back to finalising what's been going on around the country. So save your questions for that sort of question time halfway through, and then at the end we can do what we normally do, and I can be here for as long as anyone wishes me to be. All right. So disclaimer first of all, because we all need those, and you've seen that before for the people that have joined these sessions, these workshops that we do. For the people that haven't, you can have a look at the end, but this is general information, so it's not personal advice in any manner, financial or otherwise, so please treat it as such. Just a little bit of background for the people that haven't attended one of our workshops. We've been around for a while, so founded the original businesses back in 1988, and at that time it was after I'd become a medico, and we started the advisory business, which was mainly for peers, so young doctors, and that then over time expanded to the other professions, the legal profession, the accounting profession, people in finance and banking. And as we all know, a lot of those people actually move around offshore, so they became expats, and we developed a bit of an expat following by default. And then about 8-9 years ago, we decided to actually create a niche market, and we help Australian expats all around the world with a whole host of different things. As you can see there, there's the advisory business, Unicorp Partners, there's the international consulting business, which is Wise Guru. Smart Loan is our mortgage business where we assist people with their lending needs, and Aussie Property Guru is the Australian real estate business. So clients can use one or more of these functions depending on what their needs are. And as an organisation, I guess it was built originally in helping young medicos, but we found that after a while, whether you're a doctor or a dentist or a banker, most of our clients had pretty similar needs. They were all very time poor. They earned higher incomes and worked long hours, obviously. So they needed someone to assist them with all of their needs. And most clients like to have some exposure to residential property, we found, where a lot of these services aren't actually tailored for that. So that's how we then went and try to assist people with their investment property needs. And through the lending business, of course, we help people with finding their homes, I suppose, because for a lot of Australian expats especially, you're going to buy a property which you may want to live in when and if you eventually return to Australia. So it's a fairly holistic situation, and we've been doing that for a very long time. It's grown, and each of these businesses have basically stood on their own 2 feet as individual concerns, and use them as you choose. So if we're looking at what we're going to do tonight, the important questions, I guess, that a lot of our viewers have been raising and that we've heard, go around certain, I guess, parameters, where one of them is obviously, is the RBA going to raise interest rates sooner than they say and sooner than people anticipate. I'll go through that in a bit more detail. They're obviously focused on employment rather than unemployment, on inflation and making sure that it stays within their target band on a sustainable basis, and most importantly, wages growth, because that will generally help drive inflation. So we'll go through that. The other thing that's really important, and actually a great positive, because interest rates are so low, it's possible to positively gear residential property in some really good quality markets in, say the East Coast capitals in particular, which was never really able to be done, and also some great regional markets. So we'll have a look at what that means for people. The other one that's important and topical now, I'm currently in Sydney, and if we look at the lockdowns that are occurring, people are saying, well, what about population growth or the lack of population growth? And what about, international students not coming to Australia? In fact, as we all know, it's now even more difficult to come to Australia since the recent reduction by 50% in the caps of people allowed to come back into the country. So those issues are really, really pertinent. And then, the new work from home situation, which is evolving the whole time and I think maturing very quickly, where a lot of large employers are saying to their staff, look, this could be around for a long time, and it might be a situation where you can work from home and come to the office and do a combination of the two. But that, I think, is creating some further opportunities if you're a property investor and looking at where you might want to buy something, in the ensuing months and maybe years. And then the other chatter that's been fairly relevant and getting louder is, people saying, when are the regulators, mainly APRA, going to start pulling some macro-prudential levers in terms of slowing down housing price growth? So they're all important features. I'll talk through those with you in more detail tonight, and if you've got questions around that, I'll answer those. So I guess the important thing is, as we all know, Australia is a very big place. It is a vast continent, and therefore research is really important because, if you think about it, what's going on in Perth and going on in Sydney or Darwin or Hobart is very different as we sit here. So we use all the national research houses such as CoreLogic and Urbis and Oxford Economics, etc. And of course, the ABS, the Australian Bureau of Statistics. But we also put our own practical overlay around all of those numbers, because I can sit here and look at statistics all day long, just about every day, and you'll walk away from that not really knowing what it is that you want to do, because there's just too much information and it creates more noise than light. So if we look at this, firstly, is the RBA going to be forced to lift interest rates much sooner than expected? I really don't think so. But as I said on Tuesday, after the RBA board met, there were a couple of subtle changes there, where in the conference thereafter, Philip Lowe, the governor, said we're not going to raise rates before 2024, and they've said that on numerous occasions in the past, but they've always said at the earliest, and those few words were removed from the commentary this time, and it gives us some indication potentially that they're going to change their rhetoric slightly. I don't see rates running away, and I'll go through that. And I think rates, when they normalise further, will remain lower than they did in the previous cycles. We'll go through why. Pardon me. And the other thing that was relevant, I thought, was that most commentators expected the RBA to basically go into more of an open-ended QE scenario, where they would continue to buy $5 billion worth of bonds on a weekly basis and review that. But they've said, well, we're going to buy $4 billion worth of bonds, and we're going to review that in the after the September quarter, and perhaps adjust that if necessary. So that in its own right is reducing some of that quantitative easing, some of that stimulus that's coming out into the market. And one of the other things I suppose that is worth noting is that the RBA or the government's not actually issuing sufficient bonds to meet the market's needs. So part of this reduction, I guess, is not going to be quite as hawkish as it would otherwise be, even though it's still a very loose monetary setting. They're looking to stimulate the economy. And I think with what's happening in the Sydney lockdown now, or New South Wales contributes over 32% to Australia's GDP. So, the Australian economy is going to take a hit out of this. And I think the RBA will look at that and continue with its supportive stance, obviously. So more on that later on as well. So if you look at this slide here, interest rates, and we're talking about fixed rates here perhaps, but longer term interest rates will generally move as 10-year bond yields do. So in that slide there, if you look at the cash rate, that's the red line at the bottom, and we can see, as the RBA have said, that's going to remain at 0.1%, 10 basis points for the foreseeable future until 2024, and then start rising. But if you look at the blue line, and this is expectations from Westpac, current ones, you can see that's going to lift. So eventually you're going to see a bit of a normalisation there between the cash rate and the Aussie dollar 10-year rate as the spreads narrow. That's going to take some time, but if you look at several of the banks now, they're anticipating that the RBA could start raising rates in 2023, and some of them even in later 2022 next year. We'll have to wait and see and look at how the numbers play out. A lot of that depends on how the COVID situation is handled in Australia. And if you don't know, the biggest problem I suppose that Australia has is that such a small percentage of the population has been fully vaccinated, around 10%. So, these are things that really pose a bit of an issue for Australians, and for the economy. And I think that will also make the RBA be very cautious in terms of any further tightening that they may look to do over the ensuing 3 years. So if you have a look at this, this is a Westpac forecast from the other day, looking out to 2024. If you look at the cash rate, the bond rates, and the swap rates, they're saying, well, the RBA actually is going to keep the cash rate at 0.1% until early 2023. And they can see by the end of 2023 that the cash rate will be up to 75 basis points, and then 1.25% by December 2024. If you look at the Aussie 10-year bond rate there, the latest is actually not 1.45. This is a week old. If you're looking at about 1.35 today, but 1.9 by the end of this year, 2.10 by December next year, and 2.3 by December 2023. Interestingly, their forecast is similar for the US 10-year bonds, and they're looking to see that peaking around that level, late 2023, early 2024. And then the last one at the bottom there, obviously of great interest at the moment to Australian expats, more so than people living in Australia, because they're not going on overseas holidays. But expats do have, I guess, more of a daily exposure to the Australian currency cross rates, depending on where they are, whether it's US dollars, pound sterling, Sing dollars, etc. But the Aussie dollar actually has been an underperformer in the last in the last couple of months, because I would have thought it to be somewhat higher at this stage. If you have a look at what's happening to commodity prices, the A dollar could really be trading at about 90 cents to the US dollar. Last time when we saw commodity prices at these levels, the Australian dollar was over parity with the US dollar, and I still believe that going through to the end of this year and into next year, I see the Australian dollar firming due to those reasons, and obviously it will change its value with other currencies in a relative manner, depending. But something to I think worth bearing in mind. So if we have a look at then the other issues there are, people are saying, look, there's so much, private sector debt out there, and that's true. But the cost of servicing that debt has kept coming down as rates have come down. And if we look at it now, it's never really been more affordable to borrow money and buy a home or buy an investment property or invest into other things. And in a lot of ways, that's exactly what the government and the RBA are trying to achieve. They're trying to stimulate the economy. They're trying to create full employment. Phil Lowe knows that, in reality, we probably need an unemployment rate, definitely with a 3 in front of it, and perhaps even a 2, to allow wages growth to really kick in and drive some inflation. They haven't been successful for the last 6 or 7 years in getting inflation anywhere near their target band between 2 and 3%, and they want that to be there sustainably before they start to tighten. So again, a very important issue to look at. Something else that goes back to the question I raised earlier about yields and potentially positively gearing investment properties. It depends on rental incomes as well as interest rates. And rental incomes or rental yields are generally driven by demand. So if you look at vacancy rates, they're very different there state by state, as you can see. And it's mainly WA and Perth and Brisbane that are leading the race, as it were, in terms of low vacancy rates. And as you can see there, Sydney and Melbourne are obviously going the other way, and a lot of that's due to lack of international students, so lack of immigration. Albeit a lot of those immigrants may be temporary, but obviously that's going to put pressure, especially on smaller inner city style investor grade apartments, and they're probably feeling the pinch most of all. So if we get our technical glitch correct here, if we look at what's happening in terms of international migration, so net overseas migration, they call it NOM, and you can see there how, and these are lagging numbers obviously because this takes time to get assessed by the government bodies, but you can see the drop off is massive from March last year when COVID basically hit to September last year, and then if you look at December, net overseas migration 3,300 people. So that's a massive drop. People that have tuned into our workshops before will know that the 2 cities that accounted for the lion's share of international migration, a lot of that was driven by by students as well, were Melbourne and Sydney, sort of around 77 to 78,000 in the 2019 year, and obviously now zip. So that has an impact. If you can see that graph there, if you look at that dip in 2021, this year, it's negative, and then next year it starts to stabilize and then improve again. And look, that's something that, obviously these are forecasts, but we've got to look at, because there's a lot of pent-up demand, I think, that's being created, and it's hard to model that. But I dare say that when international borders open up properly again, there could be a massive rebound of migration to Australia, because it's become, I suppose, a location that more people from around the world would like to come and live in. So that's important. It has some other ramifications economically in terms of, I guess, labour force, wages growth, or lack of it perhaps. So they're all other things that we can discuss at another time, but all of these things are interrelated. So, the latter question I had there in terms of when are these macroprudential measures going to be triggered by APRA? It's an interesting question. Look, I think potentially later this year, early next year, we'll see some of that coming through. But right now, if you look at it, I mean, the RBA tells us, and it's right, bank lending standards are very robust in Australia, and they haven't been, becoming lax. There hasn't been an uptick in higher risk mortgages or higher lending ratios to cause them any great concern. And as we can see there, the growth in monthly lending values is still being driven massively by owner-occupiers, home buyers, right sizes, call them what you will, but it's not interest-only high LVR loans to investors. That's clearly seen there. The investors are now starting to come back into the market, as you would anticipate, because people are recognising this has been a tremendous opportunity, I guess, for many people to enter the market and potentially positively gear their investment. So that's being recognised as perhaps not a bad situation to partake in. So, let's have a look at that there. That gives you an idea of the measures, I think, that the regulators look at. And I think this time it won't be like in 2017, where the impact was actually a decline of 10 to 15% in property prices, probably one of the most significant ones that I've seen, and it was purely manufactured by the regulators. But then you had the political impact of the Labor Party potentially winning the federal election, bringing in massive changes to capital gains tax, gearing, etc. So none of that occurred. But this time around, I think it'll be far more nuanced. I think the regulators have learned that you can be very selective in what you do. So I'd foresee things like there may be some pressure on high LVR loans to investors, interest-only loans. Perhaps there'll be a greater scrutiny in terms of loan size to income ratios. So it'll be a combination of these factors. And the other one that's most important, I've seen a little bit of it creep in already, is the serviceability rate that the banks will need to use when they're assessing a borrower's capacity to repay that loan. And we as expats know it's not that easy to get loans, especially outsized ones right now. So I think those standards are very robust. So the new rules, and it's interesting because people ask me this all the time, but these new rules for Australian tax residency are simply the recommendations that the Board of Taxation made in their report, which was issued in 2019. And this year's May federal budget has sought to modernise the current tax legislation in terms of tax residency. And bear in mind, that hasn't been changed for about 80 years, so it has been a long time. And they're trying to make this, I guess, more objectively based, but I do wonder about that a little. So let's have a look at, there are only proposed rules at this stage. Any of this needs to get passed through both houses of Parliament, and I dare say there'll be some discussion. There may be some amendments to these proposals as well, but a lot of people don't actually know what they are or what's happening now. So the proposed rules are based on a bright line test or an objective factor. So in other words, if you spend 183 days or more in Australia, you will be considered an Australian tax resident. That's in any income tax year. So pretty important to remember that one. The second one is fairly much similar to what we have now. Right now it's a superannuation test, but if you're a government official deployed on overseas foreign service, you basically remain an Australian tax resident. And I think most people pretty well understand that. But I guess here's where it becomes more interesting. Under these new objective factors, an individual would start to become an Australian tax resident under the proposed new rules if they spend more than 45 days in Australia in any income tax year, and they tick the box for 2 of these 4 sub-tests, these factor tests. And the proposed factor tests are: number 1, you have the right to reside permanently in Australia. In other words, you're an Australian passport holder, citizen, etc. So Australian expats will tick that box. And then if you go to the 4th one, have an Australian economic interest. If you own a property in Australia, an investment property, you'll tick that box. So that's 2 out of 4. In other words, you would then potentially have to start looking at how many days you're going to spend in Australia. The second test, Australian accommodation. Now that relates to having a place to reside in, to live, that's open for your occupation. So if people have left a home in Australia when they move overseas and it's vacant, they go back, when they go to Australia, they go and live there. You would tick that box. Or potentially if you've made it an Airbnb property, but it's always available for you when you go back, you could fall into the same situation. And the third one there, Australian family, that relates to a spouse and children under 18. So important to look at all of that in context. We'll see what happens as this unfolds. Clearly there's a lot of time to pass under the water because it wouldn't take effect until the 1st of July after it receives royal assent. But let's look at it from a practical viewpoint because that's what people are interested in. So you're an Aussie expat, that means you're an Aussie passport holder, you've got an investment property or you've got a home that's now rented out there. You've got to start thinking about if you're going to spend more than 45 days in Australia, you could actually fall foul of these new rules if they become passed into law, because under the current law, we've got to look at, where you would sit. And I'll go through that because a lot of people are not really 100% sure about what the current law actually looks like as well. So from a pragmatic viewpoint, again, I guess the good news in some respects is that it depends on where you live too. So, and I've put up there an example of Singapore and the UAE. So if you live in Singapore, it's a jurisdiction that has a double tax agreement with Australia, whereas the UAE doesn't. So if you live in Dubai, you don't have a DTA. And the interesting thing is that under current legislation and potentially under these new rules as well, if you live in such a jurisdiction, the tiebreaker test under that double taxation agreement will come into effect, which basically says that you're going to be a tax resident of one, not both of those jurisdictions. So if you're a tax resident of Singapore, then you're not going to be a tax resident of Australia for your worldwide income, and you'll pay tax, as we all know, on Australian taxable income, or ATI, which say rental income is for your property, at non-resident rates. So most people are aware of that, and the ones that aren't, I can certainly make you aware of that. So let's have a look at things as they stand now. And under current tax residency rules, and as you can see on the right box there, I'm not going to talk about the other interesting one, which is ceasing becoming an Australian tax resident, because that really looks a little bit more problematic if some of these new rules are adopted, and we can go through that another time, or if people have a separate question about that, they can email us or contact us and we can discuss that. But under the current situation, legislation as it stands now, it's where you reside, it's where you domicile, where you live. So you've got to be able to show that. And most people will know, if they're Australian expats, especially longer term ones, that can be demonstrated fairly readily. You, your spouse, your children, your dog have moved overseas and are living somewhere, and you're going to be there for an extended period of time, and you have no intention of moving back to Australia. So it's relevant and it's misunderstood. So we're going to have to look at that in more detail, and I'll go through that in Q&A. And then just before we go into the questions, let me just have a look at some of the other situations that Aussie expats should consider, and how to plan, I suppose, using the tiebreaker test if necessary to get themselves out of a spot, as it were, or otherwise just relinquish yourself to the fact that you've got to spend potentially 45 days or less in Australia to stay outside of the dragnet, as it were, that could be created if this legislation gets passed as it is. So, look, at this point in time, why don't we? I save up those questions for maybe another 5 minutes or so. But if you can think of anything that's relevant, we can go through the current situation. I just point out there, if you have a look at that flowchart on the left, you can see even under current law, let's say you did spend a longer period of time in Australia, it's still potentially possible to, when I mean a longer time, say over 183 days, you may still be able to be judged a non-resident under a tiebreaker situation, double taxation agreement jurisdiction, depending on the circumstances. So a lot of these things, generalizations are great, good to know the background, but more important, I think, to recognise what's actually happening from a practical viewpoint. I was speaking to someone today in relation to this, because, you know, we, especially now with COVID, we have quite a few Australian expats where, say, their wife and family, for whatever reason, has moved back to Australia and has either been stuck there or it's staying there for some time, and they're saying, well, what happens to me? I'm still in Hong Kong or Dubai or Singapore or London. You know, what about my tax residency? So that's an interesting one. It's certainly far more of a grey area than what I've been describing earlier tonight. So all of those things need to be addressed. And I think for most people, as I say to them, we can certainly help you with the overall, but then go to an international tax specialist accountant to assist you with that and provide some written advice if you require it. And we can certainly send you to our panel of advisors that can assist you with that. Okay, so let's have a look at property as an asset class. And this slide again from last week from Westpac. Evans was kind enough to share his thoughts on that. So this is what the bank actually has forecast currently, June 2021, in terms of the various cities around Australia. If you see Sydney at the top there, they're forecasting a 16% increase in housing prices this year, followed by 5% next year, and then a drop of 1% in 2023. As you can see on the right there, some of those numbers I'll disagree with slightly, but they're saying Sydney is already up 16%. Melbourne, as we can see, they've predicted a 12% increase this year, 5% next, and then -1%. Melbourne's up 10%. Brisbane, they're forecasting a 16% increase this year, 10% next year, and 4% the year after. It's up 11 and a bit. And you can see there, Perth, similarly, 10, 8, and 3. It's up 9. Adelaide, very similar to Perth. Hobart also, but Hobart, as you can see on the right, is up over 15% already this year. So overall, if you look at the Australian, and I don't believe in this, but anyway, if you look at the aggregate figures for Australia as a whole, housing's up 12.5%. I think you need to be far more granular than that. You need to look at the cities, you need to look at the major regional markets, and then you need to look at, you know, dwelling types within those as well, so that you actually come up with something a lot more meaningful. But interesting, that's what the bank thinks. And I look back to, say, not this time last year, but even a little earlier, April, when most banks were calling for a 20 to 30% plus decline in Australian housing prices. And I was one of two forecasters that actually challenged that view very strongly. And I must say that we got it right. And over time, the banks have now moved to, I suppose, be on the same page as we have been for some time. So quarterly dwelling values, and this is a quarterly update. So in the June quarter, if you have a look at that, there have been strong rises in virtually every market, but you can see there has been a peak, I suppose, reached, and there's been a small decline in some of those areas. It's evident, as you can see there, especially on the graph on the left. Sydney, Adelaide, Brisbane, Melbourne, and Perth. So good news, I suppose, because you can't have prices rising on such a steep rate continually. It's unsustainable, and I think that is good news also, obviously, for first home buyers and generally for people trying to buy a home in Australia to live in those capital city markets in particular. And in the 3 months to June, again, most capital cities saw the strongest dwelling value growth across the upper end of the market. And I often say this to our clients when they're looking at investment properties: don't look at the bottom of the market. You're better off looking at the higher quality upper end properties if you can afford to do so, because what we generally find is over a long period of time the capital growth will be far better, and it's cyclical, as are most things, I suppose, in these markets. But this is really showing that, as you can see, especially Sydney, Melbourne, Brisbane, Adelaide. So important. Interesting to note that Hobart and Darwin, it's actually the bottom quartile that's showing the greatest rate of growth. So if we look at this, most people will remember that the last peak was reached in 2017, especially on East Coast markets. And that's when APRA came in with its macroprudential measures, but they were a bit sledgehammer-like. And as you can see, produced a very significant decline in values. So that had an impact, obviously, on the Australian economy broadly. And I don't think we'll be seeing that this time. As you can see, this is, again, a forecast from Westpac in relation to where they see prices going. And you can see, the increases in Sydney, Melbourne, steeper in Brisbane and Perth. But more interestingly, if you add some of the important regional markets to this, so as we've seen, the work from home areas have really benefited from, I suppose, the fallout of COVID. Markets such as the Gold Coast, Sunshine Coast in Queensland, Central Coast in New South Wales, in the main. And those markets, if you look at that graph, and we're seeing this anecdotally on the ground, those markets have really risen at a steeper rate than those capital city markets. And it looks like they're set to probably continue to do that for some time. Rental conditions look very important. And I've mentioned earlier that both Melbourne and Sydney obviously falling into the situation where there has been no international migration, no international students, and that's put a lot of pressure on rents and also on vacancy rates, especially in inner city markets where you've got a whole lot of small investor grade apartments that were generally rented to international students. And those markets are suffering, and they're still suffering now, although to a somewhat lesser extent, I suppose. So it brings us back to, in the whole, if we look at property, though, a lot of people say, well, what are these prices doing? I mean, it's going crazy, especially in Sydney. And, I'd like to draw people's attention to the fact, and a lot of Aussie expats will know this because they live all around the world, that this is not an Antipodean phenomenon. Property prices have been going up strongly since COVID hit last year in a lot of markets. In fact, New Zealand's into nosebleed territory, as they say. But if you look at a lot of developed nations are way ahead of Australia in terms of rates of increase, and many countries that you wouldn't even have thought of are way ahead of Australia. So it's something to bear in mind and to look at in context from a global viewpoint. Obviously, the other area that drives the price of any asset is supply and demand. And if you look at that, we've had this massive spike in people looking to purchase their first home. So the home builder scheme the federal government introduced last year, and lots of different specific targeted stimuli measures have brought forward a lot of demand and created this increase in detached homes or in detached house building. But the opposite is true for the apartment market, and that's really at sort of pretty much not all-time lows, but close to it. And obviously, as you can see, they're still over 10% below its decade average. That'll take time to turn around because those sort of dwellings obviously take a lot more planning, a lot more time to get through the regulatory process, and then pre-sales and funding. So it takes years, not months, to do that. So what's happened to this declining trend in investor participation? Well, it's pretty well stopped. And as I said earlier, lending growth has been driven by owner-occupiers, or right-sizers, as I call them, and investors weren't really participating over the last 6 to 9 months to any great note, but that's changing and it's ticking up, and I see that continuing, especially if we continue to be able to access the current suite of low interest rates, and I'll come to some of that later, because I think we've probably seen the bottom of the cycle with fixed interest rates, and we'll see some movement in that. I think targeted more to the homeowner, the owner-occupier market, than the investor market, because that's where all that growth has been. And there have been some very, very aggressive cuts by some of the major banks to entice people to do that. But let's look at it overall. Since the start of the COVID pandemic last year, March of 2020, to now, have a look at the cumulative change in dwelling values by capital city. And you can see there that Melbourne actually has been the weakest performing capital, and that's largely due to the horrendous lockdowns that the people of Melbourne unfortunately have had to endure over that period of time. But as you can see, it's still a very heartening, I suppose, outcome if you're a property owner in any of those places. And you look at in the middle there, Sydney's up 14%, Adelaide's up 14%, Brisbane is up 13%. So really, and the ACT has been a very, very strong market, up 18%. If you look at Darwin, for example, I mean, you've got to look at that in context, as you have to with Perth, because they're the two markets that are still quite a long way below their previous highs, which was set 7 years ago. So before we go into the next part of the presentation, I'll just see if people would anyone like to ask any questions at this point in time? No?
Andrew, it's Guy. I think you can see me now.
Yeah, that's better.
Just
Hi,
a question.
how are
Can you
you?
hear me?
Yep, I
Yeah.
can.
Hi, good. Yeah. Question for you. I normally reside in Singapore, though I'm rather locked down in Sydney at the moment.
You're like
Singapore
me.
real estate doesn't. You're in Sydney too.
Yeah.
I'm a ground zero in Bondi, but of course it's left and gone to the other suburbs. Singapore real estate doesn't seem to have followed other countries. Do you have a view on that?
Yeah, I do actually, Guy. It's interesting, when we moved in quite a few years ago, I was of the opinion that it would be great to buy something there, for a lot of reasons. But the more you look at the market there, which part of Singapore are you in?
I'm near Botanic Gardens, so Bukatina.
Yeah, okay. But, if you have a look at the number of dwellings that are being built at the moment, and we're talking, not just tens of thousands, but hundreds of thousands, it sort of exemplifies a little bit of what's happening in the marketplace there, in my opinion, that there's a disconnect between supply and demand. So it's a bit like a field of dreams, I guess. The way it's looked at is you build it and they'll come. But the market in Singapore, and you also know the preference of the population in relation to dwelling types. So they will always want the newest and the latest condo to buy. So it's not quite the same as markets in other areas such as, the US, the UK, Australia, Europe, etc., where established housing has got great value as well as new housing. So it's different. And I think there are also some structural issues that exist there in terms of stamp duty imposts if you're not not a citizen or a PR holder. So it's a different kind of market. It's a little bit more subject to, I suppose, governance. And if you recall, about 3 years ago, 3 years ago, when the government decided from 1 month to the next to change stamp duty significantly. I think that's probably been, to my mind, some of the issues. Does that sort of feed into
thanks. Yeah, no, it's just a view.
Was there something?
Just I did. I mean, I see quite a lot of expats kind of leave as well, and I wonder whether post COVID, when we get to that stage, we'll see more people come back in, for example, from Hong Kong as well. But it's quite an on market. I watch Australian real estate, and I'm a holder, just haven't gone through the roof. And I look at Singapore, where I'm a holder as well, only small. It's just flat. Maybe up a touch, but just flat.
It is, and I mean,
thank you.
The activity in the market's not as high. While a lot of the market activity is always driven by developers, they're putting out new incentives and so forth, and all of those numbers then pop up in the statistics. But if you're an existing property owner there, sometimes the market doesn't look the same as what's brought out in the stats, I find. So, yeah, I agree with you. Look, I think people will return to Singapore, obviously, and when the world normalizes. A lot of what's being spoken about, and we've got lots of clients in Hong Kong, we're not really seeing as large a move from Hong Kong to Singapore as I would have thought, reading things on Bloomberg, etc.
Interesting. Thank you. Thanks for your view. Yeah, it's interesting. Thank you.
Yeah, and look, anytime when we're both not locked up in Singapore, by all means, reach out.
Well, I seem to everywhere I've gone in the last 12 months, and I've been fortunate enough to travel still, just Australia, New Zealand, Singapore. Lockdown follows me, so you don't want me coming back to Singapore.
How long are you in Sydney for?
Well, we've only been here for a couple of weeks. We're planning to be here for 3 or 4 weeks more, but I doubt that we're going to be able to get back in that time. Looking at things now, it's pretty bad, as you know.
Yeah.
So we'll see. But you can't, as I said to my wife, you can't control it. You just you can working remotely is pretty easy now.
Exactly.
No, you can't go out to a restaurant. But, we can walk. So
that is a shame, but look, I feel for you, and I'm exactly the same position. And I wish you all the very best with it. And I hope the lockdowns don't follow you any further.
Good, thanks, Andrew.
You're welcome. Anyone else have any questions?
Oh yes, please. My name is Simon.
Hi, Simon.
How are you?
I'm really well. Whereabouts are you?
I'm in Singapore. I've just moved down here from Hong Kong, actually.
Well, there you go.
Movement is possible, albeit limited, and that wasn't very simple. I've got investment properties both in Sydney and in New Zealand. I'm a New Zealander by passport, Australian kind of as well.
Okay.
If you were picking a market, which one would you pick? Most my investment properties, and it's location. Obviously, mine in Australia is in Sydney, and in New Zealand is in Auckland. I mean, how do you see the different markets performing? This has been very interesting to hear about the Australian context. Do you see the New Zealand market following that, or what do you think?
Look, New Zealand and Australia are in a different position right now, economically, in terms of, I guess, where the economy has arrived. I think Australia's in a far different position to New Zealand. I see the RBNZ continuing to lift rates. And the interesting thing there, the Reserve Bank of New Zealand is now also looking to try and control housing prices, whereas, the RBA certainly isn't, as they point out whenever they're asked. So they are different markets. I see housing prices in both markets continuing to rise. And as I say to people, it really depends then on what quality your property is. Where is it? Is it in a sought after area? For example, where's your property in Sydney, Simon?
Neutral bank.
Yeah. So, hey, a great quality asset in a great location is going to continue to increase in value. And Auckland, I think, as the market has shown there, even lower quality dwellings there are continuing to rise in value very strongly. So I think both of those will. But if at the second half of the presentation actually goes through the various Australian property markets, and you'll get all the information that you're, I guess, looking for there in terms of where we think might be some of the better areas to look at now if you're going to purchase any more.
Excellent. Thank you so much.
Anyone else have any questions that they'd like to throw up now before we head on? If not, then let's have a look. And Simon, your question does relate to it. What does all the data tell us, and how do we use that research? So, you're talking about New Zealand and Australia. Well, in Australia, residential real estate is the largest asset in the country, $8.6 trillion currently, which is, a pretty significant number. So the regulators, the Reserve Bank, etc., have to tread carefully, because this sector employs a great many people in all sorts of ancillary business enterprises, and it's a really important one to get right. The other thing that is important is, people asked me just before, what's happening in the Australian property market, and gosh, there is no Australian property market. As I said, what's happening in Darwin or Hobart is so different as Sydney or Melbourne or anywhere at the same time. So there is no one market, and this has got nothing to do with 4 and 20s, that famous food source that's developed in Australia. But the easiest pie is, if you've got an investment property or going to get one in an area that has population growth, infrastructure growth, and employment growth, then you're going to do pretty well, I think, as opposed to just choosing something on a qualitative basis. So if you look at the different markets, let's look at Sydney. New South Wales is the most diversified economy in the country, and that's why I said this lockdown that's currently happening here is going to have a meaningful impact on the rebound in Australia's economic growth, because New South Wales contributes over 32% to national GDP. So it's something we need to keep in mind and look at the length of this lockdown in terms of its economic impact. If it's shorter, clearly, it'll be an interim situation. So I wouldn't be too concerned about that. I think the recent market rebound is going to continue. So Simon, just as I said before, I think that will keep on growing. I think, you know, housing prices will continue to rise. Some of that's being driven obviously by interest rates or the low interest rates, but in general terms, if you've got property in these locations where there is a limited supply, you're going to do, I think, continue to do fairly well. It's really hard to find value. I used to say it's hard to find value in quality, but it's now pretty hard to find value anywhere in the Sydney market, to be honest. And that's not to say that that's not going to get harder, because it may well. And some of that's obviously driven by other factors, lack of stock, lack of listings, etc. Will that change during a lockdown? Yeah, it will, but we've seen what's happened in Melbourne, and I don't think that change is anything but a transitory situation. And I think also people now are quite familiar with doing online auctions, etc. So it's not going to have the impact it did initially last year, where we had lockdowns, where you had no physical auctions, people didn't know how to react, and transaction volumes just plummeted and fell through the floor. I don't actually see that happening this time. Pardon me, the downside risks obviously are going to be, I think, brought out by affordability issues. So at a certain point in time, the affordability issues will creep in, and people simply won't be able to afford to continue to pay higher prices. And that's always, I believe, something that makes a market far more, I guess, sustainable longer term. And some of that should creep in, I would think, later this year. So if we look at what's happened in terms of the actual numbers for the last quarter, Sydney's up 2.6% in June and 8.2% over the quarter. That's very significant, one of the highest rates of increase in many, many years. So Sydney's up 15% over the last year, and obviously it's currently at a record high, as you saw by that graph I showed you from Westpac, in relation to the last high being in 2017. Then if you look at the next one is Melbourne, you know, it's had post-COVID lockdown rebounds, had a couple of them, because unfortunately they've had some really severe lockdowns there, as we all know. And we've seen and learned from that, you know, what human nature does and what people do. When those lockdowns finish, the sort of rebound that comes. Unfortunately, Melbourne has had to also deal with a twin impact of no international migration, so no students, and that made a massive amount, about just under 80,000 in the last proper year, which was 2019, that we have records for. So that's a big issue. And generally speaking, I'll come to this a little later, we look at interstate migration. Melbourne used to have the highest interstate migration in the country, and now the boot's on the other foot to some extent. So it's had the weakest growth of all the capitals, as I've said, over the COVID period, up just over 5% between March 2020 and June this year. So, you know, the weakest capital city market. And I think, look, I think it will continue to pick up, but there are still challenges there, albeit now it may be Sydney that faces those. So in the next quarterly review, we'll see what the numbers tell us. So if we look at the numbers there, Melbourne for the quarter is up 4.6% and 7.7% for the last year. So about half of Sydney in both instances. And Melbourne values are also currently at a record high, so they've exceeded their 2017 peak. And then if we go to the other side of the continent, to Perth, there's been some great news in Perth, which is long overdue. It's interesting there because the state economy, relies on the commodities sector, mining sector, and that's now been a plus because that's, essential business, employment's stable, wages are high. You've now got low vacancy rates, which was the opposite to what we looked at, say, perhaps 12 months ago. You've got really all the factors working to drive property prices higher then. Don't forget, they were coming for a very low base. And I think that's what's so good about this, because the people of Perth obviously have had to live through this declining market phase for over 6 years, and now they're seeing a pickup, which I think will continue. The rate price growth has rebounded. Vacancy factors are so coming right down. So I think Perth looks pretty good. If we look at the numbers, as you can see there, Perth is up, pardon me, 2%, just over 2% for the quarter, just under 10% for the year. So that's really good. However, Perth values are still 14% below their record high, which was set in 2014, sort of at the height of the mining boom, if you like. So anyway, good news for the people who own property in Perth. It is starting to show that cyclical upturn. So 2 things now. Let's have a look at a question that we often get asked, and should I buy an old property or a new property? There's no right answer for that. It just depends. It depends on a lot of things. Potentially for a lot of our clients who are expats who are very time poor, and if it isn't for I suppose a COVID lockdown situation, normally most expats would be travelling all the time, so it makes it even harder to research things and to, I guess, spend time on perhaps looking at renovating an older home or buying one and seeing what time will bring you in terms of can I move into this at some future point in time, etc. So for a lot of our clients, something that's new, that's built with modern construction methods and materials, has very little or no maintenance, generally is a better outcome for them. It's easier to rent, and tenants will tend to stay longer. Quite often you'll get a better quality tenant, and most of our clients want a no touch, but certainly a light touch scenario in terms of an impost on their other personal time and lives. So in Australia, and we'll cover this off in another section, but in Australia we have the added benefit that if you buy a new property under the depreciation laws that we have in our Tax Act, Division 40 and Division 43, you can actually deduct the cost of the building at 2.5% for 40 years. So you effectively get to write off 100% of the building cost, and then certain percentages of all the fixtures and fittings where you need to get a quantity surveyor's report that the ATO accepts. So it's a pretty significant tax saving, and as a non-resident you're paying tax on Australian taxable income at 32.5% from $1, so a very valuable one, and we're very lucky because all the excess tax credits we can then utilise if we ever go back to Australia against personal exertion income, or if we go and sell something against capital gains. So at the end, again, easy as pie. Let's have a look. So we've been saying this for a little while now, that we think southeast Queensland is going to give you potentially the best bang for your buck. And it's interesting to note, if you recall earlier in the presentation, some of the banks, Westpac there, Bill agrees, seeing the highest rises in this current year, next year, and also the year after, where they see Sydney and Melbourne coming off a little bit, not much. So in Queensland, it has a very diversified economy. One of the downsides last year was services provide a good chunk of that, and tourism is a part of that. That basically died during the COVID lockdowns. But as we also now know, that Aussies actually spend far more money when they go on holidays overseas than overseas tourists do in Australia. In 2019, Australians spent $55 billion overseas. So last year, obviously, Aussies couldn't go overseas on holidays. They had to spend that money within Australia. And this year looks to be pretty much a rehash of what happened last year. So from an economic viewpoint, sectors like the tourism industry in Queensland are getting a lot of support from domestic tourism. Pardon me. That certainly looks to be continuing. And currently being in Sydney, we'd love to go to Queensland, but we can't go anywhere. But lots of other people who can tend to do that. So that's definitely a tailwind. The other thing that's really important, the substantial valuation gap. If you look at, median prices in Sydney at 1.2 million now, it's over double to what it is in Brisbane. So you're getting a lot more bang for your buck if you're buying something in Brisbane as opposed to, say, Sydney or Melbourne. And the most important thing that I've seen is it's seen the strongest interstate migration in over 15 years. And this has been trending up for a while. COVID obviously turbocharged that because people wanted to go somewhere, pardon me, that particularly if they lived in Melbourne, where they wanted to escape these lockdowns. It wasn't just the climate change. Then you look at work from home, so people had a lot more flexibility. Employees had that. Employers were keen to give that. And that's really sustained this massive interstate migration, which has more than accounted for any lack of international migration into Brisbane, southeast Queensland. So pretty important. And the lifestyle factors, especially in the coastal markets such as the Gold Coast, Sunshine Coast, have played a significant role and will continue to do so. So if you look at the numbers there, Brisbane's up 5.7% over the quarter, 13.2% in the past year, and also currently at a record high. But if you look at that price gap, it's significant, and I think that will narrow over time, and it's not because Sydney and Melbourne are going to fall in a hole. So have a look at that for interstate migration. You can see there, Queensland 2020 and 2019, really significant number of people have moved into the state. 30,000 2020, over 30,000 people. And if you have a look at where they've come from, mainly New South Wales, and then obviously also Victoria. So as I'm saying, the boot is really on the other foot, and I see that continuing. And the states that are really seeing the biggest influx of interstate migration are Queensland, and I think it will also to some extent be WA. So if you have a look at that, sort of 2004 was the last time that Brisbane property or Queensland property boomed or peaked. And I think that we're set potentially for a similar situation where you're going to see stronger price growth in that region than, say, Sydney and Melbourne over the next 2 to 3 years, so out to 2023. Then if we have a look at the second part of the pie, which is infrastructure. If anyone's been to Brisbane, I know it's a bit difficult at the moment travelling anywhere, but the amount of infrastructure that's going in there, that's being built and funded both from the federal government, state government, and private sources is really significant. I won't dwell on this, but I can go through it in terms of what it means. The significant ones there, the parallel runway in Brisbane was completed late last year, and it still has a significant impact even with COVID, because a lot of the arrivals in Brisbane Airport during normal times are actually domestic travellers, and secondly, people travelling from across the Tasman and New Zealand. So it has a great deal of significance. Building the gaming and entertainment centre in the city there is another major infrastructure project. The Cross River Rail, look, there are many of them, and they're not just mooted, they're being built. And then if we look at the employment situation, because it's all well and good to say people are moving or want to move interstate, but they need a job, they need employment when they get there. And that's the other thing that's been happening over the last couple of years in particular, is that Queensland is actually creating more employment, more jobs available. So people are moving there. And again, to a lesser extent, but similarly also to WA, as I said just before. So I see both of those being recipients of some pretty good tailwinds that will impact the property markets in those locations. That's the latest ANZ forecasts. They've been upgraded like all the banks have. And you can see the blue bar for 2021 and the pink bar for 2022. fairly healthy forecasts. So what's the value proposition? Well, from our viewpoint to our clients, it's helping people avoid investor mistakes. And we all know this, we've all seen it, people buying into a strong market. That doesn't mean buying in at the top of a market. You should be trying to buy into a strong market of the future. And that's where those things, those attributes come in and are so important, that population growth, the infrastructure growth, and the employment growth will create that over time. And that's what an investor should look to do. Investing is about utilising the time value of money to create money through waiting and seeing those assets grow for you. It's not through spinning the wheels too hard. Waiting too long to invest is also one of these things that generally can come into play, where people spend a lot of time, if they have it, looking at information and statistics and research, and they're not really knowing what to do with all of that information. So I think that's where the pragmatic overlay and experience that you have will help with that. And the important issue is, quite often I see people say, look, I've been meaning to do something for years, I just want to do it. Well, any investment won't do, and you can't ignore your point of difference, because that's actually what's going to change that overall investment outcome for you to a great extent over the long term. So if you have a look at, what people have looked at many times, super high-rise towers, and whether it be Melbourne or Sydney or Brisbane or Surfers Paradise, we've got hundreds, if not 1,000, similar, usually, smaller investor-grade apartments going up, are probably not something that you should really partake of. Or going to mining towns that are, dependent on one particular industry. They're higher risk situations, and you might get a greater income in terms of rent when everything's going well, but when things stop going well, you'll either end up with a situation where you have no tenant, or potentially a tenant that pays very little rent, and you may not be able to sell the asset. So not really a good long-term investment option in my mind. We look at markets, as I said early on, with a lot more granularity. You can't just look at, is it Sydney or Melbourne or Brisbane? Is it a house? Is it an apartment? Because these things are all generalizations, and they're so different. So you've got to look at, regions, styles of dwellings, what are people looking for, what's going to be built there now and in the medium-term future. There are lots of things you've got to consider. If you have a look at this, and it's been an important one, we've always said to our clients, look, if you can afford it and you're going to buy an apartment that's a boutique-style property built for owner-occupiers, buy a 3-bedroom one, because that's what we find people look for. They look for those larger owner-occupier style dwellings, and that was well before COVID. COVID has actually really brought that to people's front and centre attention-wise, because that's what they want. They want more space. They want more quality. Just bear with me there. Whoop, there we go. And that's what we're seeing. In fact, research, if we have a look at this research from ANZ, points that out. That is what people are looking for. If you look at those graphs, I mean, it makes a lot of sense. I mean, we're all like that. If you're locked up working from home, especially if you might have young children, or even if you don't, it doesn't really matter. You still enjoy a feeling of greater space. And of course, now if you don't have to commute physically to an office, a lifestyle location is very, very attractive. So we've seen a lot of people move from, say, Sydney and Melbourne and move to the Gold Coast or the Sunshine Coast and continue to do what they're doing. It makes sense. So if you put it all together, what we're trying to do is make sure that people look at, if they're going to buy something, buy where there is strong economic activity and the prospect of that going forward, where already good infrastructure and amenity exists, but there's further growth to complement that, if you like, employment growth, population growth in those areas. Make sure you have some unique attributes in your property, and that should ensure your future sustainability, particularly in terms of keeping investments for a long time and being able to, if you like, do very little after you've spent the research and time to buy something, and then enjoy the fruits of your labours over time through both income and capital growth. If you look at some of the things that we would look at, this is a building that was released recently, a boutique style building, 4 or so kilometres from CBD. We tend to like things that are, I guess, I call it that inner middle ring, about 3 to 13 kilometres from any capital city, regardless. I think you'll find if you've got quality dwellings in those areas over the long term, you're going to do really very well, and history doesn't change much. So if you have a look at that, make sure, you know, they're oversized dwellings. If you're buying something new or newish, make sure it's built by quality builders so you can go and research what they've done and look at it. They use high quality materials. Obviously, light and space and architecture are becoming far more important to people, so keep that in mind. Amenity, interesting things like now, you know, dwellings are being built like that there with a rooftop situation where you have rooftop pools, etc. But it now has a walking track around the perimeter of that dwelling, which I thought is a fantastic thing, because if you're here in quarantine, as we are at the moment, you know, to do exercise and to be able to walk in the open is a great thing. The coastal markets, as I say, this is on the Gold Coast. This is on Sunshine Coast. These sort of dwellings are in super high demand and seem to get sold out, you know, very, very quickly. So it's important to get your finances in order, especially if you're an expat, because these things take a little longer, or quite a bit longer at times. So really important to make sure you're in the best position to do something when you're ready to do something. If you're going to buy a freestanding dwelling, as I said, try and look for something in a middle ring also. More difficult usually because not as much land exists. So, but they're all I guess, the sort of things that we try and find for people. So what's next? The interesting thing that we do is we make it a more qualitative thing as well. So not only do we look at I suppose you know, the architectural benefits of a dwelling, but if you have a look at the quants, if you have a look at the numbers, we look at all the costs of acquisition and the ongoing costs of ownership of something, so that you can get a pretty good idea of what the numbers should look like, and not be in that situation where you say, gee, I hope that goes well. You should have a reasonably good understanding of how well it could go, or unwell, for that matter. So, you know, this is an important one. Who pays for your property? And that's a very conservative situation, because with current interest rates, the yellow part of that pie chart, the U, is pretty much zero. A very attractive situation to be in. Have a look at that. It's all green. So, you know, people can still, you know, often clients say, well, look, how long are these low rates going to stay around? And look, as I said, I think we've probably hit the bottom of the rate cycle, but you can still, you know, I've got people currently always looking to lock in rates, and you know, 5-year rates with a 2 in front of them, you know, whether it's 2.7% or 2.8% or 2.6%, depending on whether it's interest only or principal and interest, is a really cheap rate in my mind, and that gives you potentially a 5-year window of peace of mind. Can they get cheaper? Sure, anything could happen. Will they get cheaper? I'm not that sure. So, you know, as I said initially, we have been doing this for a long time. We try and help people acquire sustainable investments that are going to give them good outcomes, both in terms of capital growth, income, and ease of maintenance and management. And we can assist all of our clients with higher lending rates. So if you're an Australian expat and you want to borrow money to buy a property in Australia, whether it's an investment property or your future home, we can generally get you up to 85% as a loan to value ratio without paying any lender's mortgage insurance. Pretty important, quite often, especially if you're a younger person that's trying to develop their asset portfolio, or if you're a mature investor and you're trying to expand your portfolio or buy something that you might want to live in later on and you're finding having to pay more than you originally thought, that extra amount of leverage can really assist you. We can go through all of those things with clients or with people who would like to become clients via a Zoom consultation. So just reach out, let us know, we can do that. And now we can go back to any questions that may have come up through the second part of that. Please let me know. Let me just change that view. Okay, anyone else have any questions after dealing with those ones earlier on in the presentation?
Thanks again, Andrew.
Pleasure. How did you,
Likewise.
Get any new pointers during that?
Always a couple of new pointers, and it's always good to be up to date too with the with the research. But yeah, there's a consistent theme that you keep bringing, and it's all about pie. It's all about quality, and doing your research. It's good.
Yeah. Well, you've found that through your own experience and behaviour, haven't you?
Indeed.
Anyone else have any questions there?
Just to thank you, Andrew. For me, that was very helpful. Nice to get some additional views.
Brilliant. I'm glad you enjoyed it. And if you need anything further, like I said, just send us an email or contact me on WhatsApp, whatever. More than happy to assist.
Super. Thank you.
Have a good evening.
Thank you.
Yeah. Thanks for that, Andrew. That was good just to get an update and see what the latest is.
Absolutely. How are you coping with everything?
Oh, pretty well. It'll be interesting to see what happens with all those residency requirements and if that goes through or not and how that affects things. But at the moment, we're not really going anywhere anyway, so it's not immediately of concern.
I was going to say, you probably haven't spent more than 45 days in Australia for a while anyway.
That's right, yeah. But it might be something we need to bear in mind in a year or so.
Yeah, look, and we'll keep people updated, obviously, because it is a fairly important issue. So, and there's a lot of water to go under the bridge with it, discussion and, by the government, by Parliament, to see where it all ends up. But yeah, by all means, if you've got any particular queries or you hear anything anywhere, then you can always reach out and contact me.
Yeah, at least there's the double taxation just in case it's needed as well.
Well, you live in Singapore, so that's right. But what about if you live in Hong Kong? You're not able to do that, funnily enough.
Yeah. So it depends where you are, and if you find yourself in a different place in a couple of years' time, whatever.
That's right. Yeah, that's so true.
Simon speaking. Thank you very much, Andrew. It's been very helpful. Really interesting chat, or what you presented. I just trying to get a sense more for what is what I see as a major failing of Australia and New Zealand down there is, vaccination rates. What are you hearing locally? Because that is the key to everything in terms of travel, in terms of probably investment. What are you thinking?
Well, it is definitely in relation to travel, and I haven't got any good news because, there's been a lot of talk, and the reality is, on the ground, obviously we've got also a large medical client base, being ex-Medico. What I am starting to hear from the industry, from the profession, is that they're ready to start giving more vaccinations as the flow comes through, and it's not far off now. But all the same, it's not like, say, Singapore. The time that it will take to get to a significant level of full vaccination, it's not going to happen in a month or two. Because it's currently at 10% roughly, so it's going to take some time. And I agree with you in relation to travel. Vaccination is certainly the key to that, but in terms of investment, not so. Especially, as I say, if you're looking at Australia, and it's a different market to New Zealand, if you look at quite simply the size of the population, the land mass, and if you just look at the exports. So, you know, from New Zealand, it's more agricultural or soft commodities. Australia's quite different, as we know. You know, bulk materials, mainly iron ore, coal, energy, etc. There's a lot more ability for people to move, as I've shown, interstate. So that's what drives those markets. That's what's going to drive those markets, I think, over the coming 12 months. Then eventually, when borders open up, and both countries have had vaccination rates reach, you know, a threshold where they can look at doing so, I think they'll both see quite a significant rebound in terms of people coming there. But as you well know, if you're not a New Zealander, it's a lot more difficult to buy property in New Zealand than, let's say, in Australia. So there's nuance differences.
I'm extremely disappointed for the two countries who had got so much right in the beginning of the pandemic, and now they have completely failed in terms of the rollout of vaccines. I'm so disappointed. I hope people vote that way.
It's terrible. And I mean, yeah, I mean, it's terrible in many ways. You know, the human cost, the economic cost, the sheer waste, like you say, of what was achieved during those difficult times last year. But, you know, to be fair, some of that is also due to a reticence amongst the population to get vaccinated. You know, there are people that live in Australia and New Zealand that don't want to get vaccinated.
Not a great forum for the discussion of that.
No. But, you know, anyway, these are all the things that exist. So we just have to hope that those numbers of vaccinations get up as quickly as possible and give everyone an opportunity to, I guess, you know, really enjoy the benefits that those countries have developed.
Thank you very much for your time.
You're very welcome, and I hope you enjoy your evening and settle in well. Anyone else like to share some thoughts or have any queries or questions relating to any of these issues? Well, if no one has any further questions, I hope you all have a great night. I look forward to seeing you at the next session. And if any of you don't know, then we do a weekly Q&A generally on a Tuesday. So if you have any questions that come to mind, please reach out, let us know, and we'll obviously try and answer those. If not live, then we can come back to you on a one-on-one basis. All the very best. Enjoy wherever you are around the world, and see you next time.
Thank you, Andrew, very much.
Thanks, Doc.
Andrew.
Brilliant. All the very best. Thank you.
Thanks much. Bye-bye.
Cheers, hey. Bye-bye.